Last Friday, spot gold staged a strong reversal rally, showing a deep V reversal and steady upward trend throughout the day. During the session, it rebounded sharply from around the low of $4,981.20 with strong momentum, eventually closing smoothly at $5,097.79, a single-day increase of more than 2%. It not only successfully stood firm above the $5,000 integer mark, but also swept away the haze of weak fluctuations in the previous few days, forming a clear bottoming out and rebound pattern, laying a solid foundation for the subsequent trend. Looking back at the market trend of the day, the reason why gold prices were able to reverse and rise was mainly driven by the combined effect of three core factors: rising safe haven sentiment, renewed strengthening of Fed interest rate cutting expectations, and persistent tensions in the Middle East geopolitical situation. When gold prices fell to the short-term low of $4,981.20 during the session, market buying power obviously entered the market to take over, and buying momentum was gradually released, driving gold prices to climb steadily from the low. Moreover, there was no obvious pullback during the rebound. Long and short sides once launched a fierce struggle around the $5,000 integer mark. In the end, the bulls successfully gained control of the market initiative, and the market maintained a steady upward trend in the late session, further consolidating the rebound gains. From a fundamental perspective, the logic supporting the gold price rebound is clear and strong. First, there are no signs of alleviation in the tense geopolitical situation in the Middle East, and the uncertainty of the regional situation continues to rise. Safe haven funds continue to flow into gold, a traditional safe haven asset, providing strong basic support for gold prices. Second, the recent economic data released by the United States has been mixed, coupled with the latest minutes of the Federal Reserve meeting, showing that participating officials still have obvious differences on the timing of subsequent interest rate cuts. This signal has further strengthened market expectations for the Federal Reserve to cut interest rates within this year. Affected by this, U.S. Treasury yields and the U.S. dollar index came under pressure and weakened simultaneously. A weaker U.S. dollar and lower U.S. Treasury yields are both conducive to the strength of gold priced in U.S. dollars, indirectly driving the gold price rebound. Third, the long-term logic of central banks around the world continuing to increase their gold reserves has not changed. This long-term positive factor has always supported gold prices at the bottom, effectively offsetting part of the short-term selling pressure and providing sufficient confidence for market buying. All content is for reference only and does not constitute any investment advice. If you trade based on this content, you should bear your own profits and losses. Please subscribe, like, and share. Thank you for watching.